Okay, then I need to change the mode, right? Yeah, okay, got it. I need to change the mode. Okay. Yeah, I did that last time.
I think it's on the top. There's a display setting above the slides. Yeah, it's above
Yes,
there.
correct. Okay. Swap.
Yeah,
Okay,
so just
got it.
stop. Yep. So this is the one. So I think later when you share your screen, you probably need to remember this step.
Yes, correct. No, I will do that. So make sure that this is on this side. So I can keep drawing over here with mine. Okay, I think we're all set. Looks good. We
Yep.
will
So I think
again
we
come back at 6:55 just
yeah
to make sure
6:55.
5 minutes before I'll just set it up. I'll just set it up 5 minutes and keep it ready.
Sure. Yeah. So I will share my screen first. So later I'll pass it on to
Okay,
you again.
sure,
Okay.
I
All right.
will
Okay.
unselect. Okay,
Sure. I'll see you again at about 6:55 to
yeah,
7.
okay.
Okay.
I'm going to mute my line and
Sure. Okay. Okay, hi everyone. We'll just wait about 20 more seconds until 7. Just wait for more people to come in and join today's webinar. Okay, it's a lovely evening. I think it's a very good week, very good weather so far here in Singapore. And all right, so it's 7 right now. I think we can begin the webinar on time today. So anyway, welcome everyone to this second part of our moving average trading strategy series. And for those of you who are attending today for the first time, we actually have this session last week as well on the same timing. We have since uploaded the recording on both our YouTube and IG Academy channel. So if you want to watch the content, then just head on to our YouTube channel and find the one that's selecting the right moving average for trading success. It has been uploaded already. Okay, so if not, a very good evening to all of you. My name is Ethan. Once again, I'm the education lead here in IG Singapore. And today we have Manish here again, who's sharing with us part 2 of the session. And today will be the title is to enhance your trading strategies with moving averages. But as always, right, before we kickstart today's session, just a few administrative things. First thing is on the audio side of things. So if you guys are able to hear me right now, can I just trouble you to locate this question box within the GoToWebinar menu panel and type in a yes. Okay, also I see a few yeses coming in and I see a few familiar names. So welcome again. Okay, so I'll just leave this next slide here for the next 10 seconds because I think the audio is all is working fine. So if you can't hear me, then it's probably something with the output setting is not correct. All right, and of course, if you are new to IG, right, then I will always encourage you to maybe not try out live trading on leverage yet. Probably you may want to start off with a demo trading account to try out our trading platform with virtual funds. So virtual funds is basically paper money where you get access to our trading platform, you get access to live prices, and you get access to the different asset classes that we offer. So you are more familiar with the platform. Okay, so this QR code, if you are new, encourage you to just do a very quick scan and register for a demo trading account. The demo login, you'll be able to test it on both the desktop web trading platform or the mobile application as well. And as always, our disclaimer, right? Just a very quick disclaimer first. So for the content that we are sharing today, right, from Manish, please just take note that it is purely educational in nature. So all the examples that are shown, please do not treat them as trading or investment advice. And CFD and Forex trading, as always, is a very high risk endeavor. So please always do your own due diligence before you place any trades. Okay, so if you're unsure, you may want to refer to our risk disclosure statement and risk fact sheet at ig.com/sg. Okay, and if you are joining here today, I assume that you are interested in educational content. So we actually have this IG webinar library with all the past recordings as well from our previous sessions. So if you have no idea where to locate this area, right, this section, right, just do a very quick Google on IG webinar library Singapore, and you should be able to very easily. The link should be the first or the second one. Okay, so once you click on it, you should see a page that looks something like that, and you can always watch our past recordings on demand. Okay, so lastly, we just wanted to highlight that we also have this Telegram channel. So if you are keen to receive some on-the-go news, if you are keen to be the first one to find out about our upcoming events, be it webinars or physical sessions, seminars, etc., please just scan this QR code and join our Telegram group. All right, so for those of you who are new today, and if it's your first time meeting Manish here, right? So just let me do a very quick introduction of Manish. Manish is an accomplished full-time trader currently, and he's based in Singapore as well. With over 20 years of experience, right? He's actually very highly skilled at identifying market opportunities using technical analysis across various asset classes. So Manish most recently also served as a market strategist for IG, providing tactical insights on cross-asset markets. He also held senior investment strategist roles with top financial institutions such as DBS Bank and Stanchart in Singapore. Okay, so other than that, he also holds this very prestigious CMT qualification, Chartered Market Technician, as well as CFTE, which stands for Certified Financial Technician. Okay, so without further ado, right, I will just pass the time right now straight to Manish for him to begin to share his strategy with us. All right. Okay, Manish, please.
Okay. Are you able to see my screen, Ethan, just to check?
Yes, everything is working
Okay,
fine.
fantastic. Lovely. Thank you. Thank you so much. Okay. Very good evening to everybody. Good afternoon or good morning, wherever you're watching this from. And thank you, Ethan, once again for such a kind and lovely introduction. I felt so nice just to listen to it because you framed it, so well and short and crisp and very nice. Thank you for that kind introduction. Okay. So just to again, just formality. Again, to reiterate that this is purely education purposes only and does not constitute any investment advice or any solicitation to invest in any financial instrument. Again, most importantly, the examples over shown in this presentation are not indicative of what the future returns will be, or past performance is not a indication of any future return. I can say that this is something that I've been using in my trading journey, and a framework that I would be most happy to share with you. But by all means, do explore on your own, see what works for you, try to experiment, and then maybe treat this as one perspective in the overall your trading dimension, and hope it's you find it useful along the way. Okay, just to recap what we did last time. So last time we did last week, in fact, we did uh, first we started with moving averages, and the reason why we first of all thought of breaking this into two is, one, we wanted to cover the basics in one part, and today's would be taking some of those basics into converting that into a strategy. And we want to use the same moving averages that we used last week to convert into a trading strategy. Now, what was the rationale behind using the same set of moving averages into a trading strategy? Because one reason is, because if I'm using, say, a 50 and 200-day just to track markets, by all means we can do that, and then I'm using another set of moving averages for my trading setup, then at the time of the decision making, it reduces the dilemma, because sometimes you will be faced with the question, oh, 50 and 200 is showing this, but this one is showing this, so which one should I go for? So to eliminate or reduce that noise or that emotion at that point in time, I thought it's efficient to have one set of moving averages right from end to end, right from identification of what the trend is all the way until setting the risk reward and exiting that trade. So we said last time we came across, we identified the process of how to find out what is an appropriate moving average for any market condition or for any markets or any time frame. What we finally came across is that we set a 10 period moving average and a 30 period moving average for any time frame or and for any market. So that's what we use finally, and that's what we're going to use today in the trading strategy. And then we saw that how what sort of uh, indications or guidance we can get when we combine both these averages, i.e., we can get a sense of the trend, we can get a sense of the strength of the trend, we can identify whether a pullback will last, whether a pullback won't last. That's essentially the gap between the two moving averages. So we looked at all these things, and that's where we stopped last week. Now, today, we will use that to take this forward in terms of identifying high probability setups for bullish views and for bearish views. So in a bullish market condition, how do we identify a setup which allows us to have a good risk reward into at that point in time? And in bearish conditions or downtrends, if we can identify some of these setups where we can capitalize. And most importantly, under what conditions these setup won't work. We also need to be aware as to why, under what circumstances, under what market conditions this setup won't work. Now, there will always be situations where a framework or a model or a strategy won't work. It may work most of the times, but it will not work all of the times. Why? Because we are trying to set a static strategy to a dynamic market. So there is a mismatch somewhere. So under certain conditions it will work, under certain conditions it will not work. For us, it is important to identify, as long as we are aware of what are the conditions it's not going to work, at least we can be mindful, at least we can be watchful when when those conditions come, or we can at least allocate capital accordingly, or just wait and watch, or just not do anything. So these are, at least we are aware of that. It helps us in getting into, say, a trap, which could be either a bull trap or a bear trap in a downtrend or an uptrend. Okay, let's start. Let's first start with um, identifying a setup in an uptrend. So let me just get my pen. Okay, there we are. So what we first saw last week we saw that for an uptrend there are two or three things that need to be satisfied. So firstly, we have to, in this condition, for an uptrend, we need a crossover. So the shorter moving average above the longer moving average, the 10 period moving average above the 30 period moving average. Once that condition is satisfied, we know that it's an uptrend. We need the moving averages to be upward sloping. And the best part is that the wider the gap, the better it is. Narrow gaps like these conditions, very narrow gaps, can also mean indecision as far as markets is concerned. And that is something that we will consider right towards the end in the second section, which is what conditions we need to be a bit careful in not jumping to the moment we see an attractive risk reward. So, two or three things. How do we identify an uptrend? So, first condition, that the shorter moving average must be above the longer moving average. Second, both need to be upward sloping. And third, the wider the gap, the better it is. Now, recall in last week's presentation, we saw that when the gap is wide, more often than not, we find that the red moving average or the 30 period moving average tends to provide support to the market. Again, I repeat, when the gap is especially wide, we saw last week that when there is a pullback in an uptrend, the green moving average tends to provide support more often than not. Now, in this case, this is also the same case where the red moving average has provided support. Now, the beauty of the whole thing is, and we'll see again in a short while also, something very briefly I touched upon last week, is when the gap between the two moving averages is large, invariably the first dip that happens after a crossover, the risk reward tends to be most favorable. I repeat again that when the gap of the two moving average between the two moving averages is large after a first crossover, when the first pullback takes place, the probability of a continuation of a trend is reasonably high, and that offers a very good risk reward to capitalize on. So that is essentially what the target is. So first, now let's go into the nitty gritties and step by step identify how, at what point in time to enter into the trade, at what levels, how should we set a stop loss. So first condition is, we saw that yes, we have to wait, and it's a pullback strategy. Now, one of the things that I'm more comfortable with, again, it's just a personal preference, I'm not so comfortable like buying at highs, you know, because when the music stops, it's not a good feeling for me psychologically just to be, buying at highs. So I would, more often than not, I want to wait for a pullback. At least, psychologically, it just helps me that, you know, we know that up to what extent the market had gone in the past, and it's just emotionally a bit more better compared to when I'm buying or chasing at highs. So this is a strategy that we want us to wait for a pullback. This is not a chasing the rallies. It's more of finding dip buying opportunities, finding dips in an uptrend. So it's a pullback, it's a retreat strategy. So in an uptrend, one has to first wait for retreat. Second, we have to first find out whether it's an uptrend. Third, the price must be between the two. If it occurs over here, or if it occurs below, no, ignore it. Just purely ignore it. Keep it very simple. Only the setup becomes live only when price is between the two moving averages. So ignore anything that takes place below. I mean the close. It may be, the candle bar or something may briefly go below that. That's fine. But as long as the close of the candle is in between, then we are live. The moment the close is below, and if you see another low in the following bar, better to ignore. Just wait for another. Let it go. Another chance will come up. So price must be between the two moving averages. Okay. Now, next step. What is the next step? Once we are able to see that price is between the two, as we saw earlier, that the trade, the setup is live. The trade is not yet live. The setup is live. The close has been in this bar. So supposing we are not on this bar, as we saw in the previous slide, we are on this bar yet. We don't know all this yet. This is only in hindsight. Supposing we are on this bar and price has closed in the middle of the bar. So we are not yet sure whether the trade setup will take place on this bar or we have to wait for a few bars. So we don't know that yet. So let us assume that we don't know anything after this bar. All this is not there. Okay. So come the next day, once we start to see price going above the previous high, which is this bar's high, once we see price going above the previous bar's high, that is when the trade becomes live. In this bar, the setup was live. In this bar, the trade becomes live. Why do I say setup was live, and what is the difference between the setup being live and the trade being live? The difference is that what if this candle was not above the previous bar's high? What if we would have seen another low? If there is another low relative to this low, I'll just get my pen. If there is a low in this bar relative to this bar, it is not yet live. We the setup will be live when market stops making a new low. So in this bar, notice that there was no new low. The market didn't go below this low, and the market in fact rose above the high. That is when the setup becomes live. So one good thing about this is that the trade becomes active only in the next bar. It's not in this bar. As long as, notice over here, price made a new low over here, price made a new low over here, the trade was not live. Again, had price made a new low over here in this bar also, the trade wouldn't have been live. So the price needs to stop making a low and subsequently needs to make a high. This is when the trade becomes live. If this is when the trade becomes live, then what is the stop loss one needs to set? The stop loss will be the low of this bar. In generally, because of these, algorithm trading, etc., it's better to set not exactly at the last tick of this bar. Perhaps maybe a few pips lower is always good. Keep some additional buffer in this case. So the first one is to see that the high of the previous bar was broken. Once the high is broken, the trade is live. The stop loss on that trade is the previous bar's low. Keep a slight buffer of a few pips. Normally, if it's like FX, at least 10, 20, 30 pips or so, depending on which time frame you are playing. But just keep an additional buffer compared to the low of that previous bar. Okay, if that's the case, then what is the risk reward? What is the target that I should be setting? The target could be easily 1:1, meaning the distance from the point of entry to the stop loss added to the entry point and extrapolated further. So a 1:1 could be at least a decent risk reward. What I have normally found is that normally you can easily get about 2-3 bars, even if it's like not such a strong trade. 2-3 bars you can easily, if you backtest, you'll see that 2-3 bars normally there is continuation of price action once you see the previous bar getting broken. So in this case, of course, the first dip happened, and after that we saw continuation of the uptrend. So, just to recap, where are we? What we have seen so far, what we saw so far in the steps from the beginning. Firstly, we have to wait for a dip in an uptrend to identify the uptrend. What are the uptrend conditions? The slower moving average has to be above the longer moving average. The gap between the two needs to be reasonably large or wide. And thirdly, both slopes must be up. This is very important, both slopes, because this is one of the conditions we'll discuss towards the end as to when it doesn't work, when this setup won't work. So the slopes must be rising. At least the slope or the 30 period average must not be falling, must not be reversed. You may come across the slope of the, because it's sensitive to price, the green line, the slope may be, when in a pullback, it may be negative. But more often than not, the 30 period slope will stay positive or flat. It will not be negative like this one. But when the uptrend is already taking place, both will be rising. Only when the pullback comes, it will be like this. So the once we've identified the pullback, once we identify it's an uptrend, we need to wait for prices to come between the two moving average. So price needs to be between the two. Once price is between the two moving average, our setup becomes live. That okay, the setup is there. Now we need to wait for a reversal. Now we need to wait for a bullish candle, or we need to wait above for price to go above this previous bar. So meaning in this bar, we will be watchful in this bar, not in this bar, because price still made a new low. So we will not be live on this bar in terms of trade. The setup could still be live, at least as far as this bar is concerned. On this bar, if it doesn't go below, then we will wait for price to go above. If on this bar, if price goes below this bar, then we have to wait for another candle for price to stop making a new low. Only when it stops making a new low, you will start to see prices moving up. Now, the exception to this is that supposing you have a candle which is something like you make a new low and suddenly you see a big bullish reversal candle. In that case, it is better to wait for the subsequent bar. Why? Because price made a new low over here. So we don't know whether should we give importance to this low or should we give importance to this high. In this kind of circumstance where it's showing both bullish and bearish, better to wait. Do not do in this one. Wait for the next bar to come up and then you can do that. So longs can be considered when price goes above the high of the previous bar we saw. Stop can be the low of the previous bar, but generally, as we saw, just keep a bit more buffer just in case there are some, odd spikes. And finally, risk reward will be 1:1. Okay. Um, Sorry. Okay, so let's see some examples using what we saw just recent in the last two slides, and we look at it from different time frames. We look at different market conditions, and we'll again just to reiterate. I know it may be a bit repetition, but it's better to repeat so that it becomes a bit more solid in terms of when you begin to look at charts. So this is natural gas. Okay, the first tip. So firstly, crossover taking place, moving average both sloping upwards, shorter moving average below the longer moving average. We have to wait for a first dip. So the first dip was over here. Now, even though the low was below, in this case, let me just get the laser. Even though the low was, and this was below the red, the close was slightly above the red. So that is fine. The trade setup was set up in this bar where the arrow shows the next bar. Once two things happened over here. One is that the low was the subsequent bar low was higher than the previous bar, and the high also was higher than the previous bar. So both lows and highs of the next bar was higher than this bar. That suggests that the trade finally became live. Again, risk reward was, as we saw, entry point minus the low of the previous bar. But as we saw, 2-3 bars easily, more often than not, I would say more often than not, 2-3 bars, at least there is continuation of that momentum once you see the bar of the high of the previous bar getting broken. Subsequently, notice over here also, in between the two moving average, in between the two moving average, in between the two moving average. Once we see price going below, close below, ignore, not meant for us. Forget it. Even though you see a rebound, that's fine. Do not chase those things. Even this was also a trade. So but as we saw that the risk reward tends to be quite good on the first dip. Of course, if it's a strong uptrend, there will be several opportunities like this along the way. But at least on the first dip, generally more often than not, the risk reward tends to be favorable. Now, what about another market? Let's see silver. Again, crossover taking place, both moving average sloping upward, slower above the longer. And notice the first dip taking place, the close, even though the low was slightly below, the close was not below, close was between. And then in this bar, notice in this bar, the high of the previous bar was broken, the trade became live. The stop loss was over here, keep a slight more gap, keep a slight more buffer, and then risk reward was achieved in the third bar or so. So 1:1 risk reward was achieved in that. So that is the example of silver. Um, Daily. What about 240 minutes? Even on the hourly charts, very similar. First dip after a crossover, and notice 2-3 bars easily the market was able to do. And so first time, second time, third time also the same, fourth time, etc., until market conditions change. And that we'll see in the final part of this presentation as to when we should avoid chasing those things. Now, interesting thing over here, one of the reason why also I took up this example case study is because over here, notice over here. Now, we'll be lucky that if something like this takes place where, immediately once the high of the previous bar is broken, straight away, the trade meets its targets in like 2-3 bars. But there will be cases like this one, where you may see a subsequent one more dip. You see, over here, one could say that one could have entered over here. In this bar, one could have entered. But subsequently, we saw a dip. But notice, even after the dip, the low of that previous bar, your entry bar, so this was the stop loss bar, this was the entry bar, the low was not broken. And that's why it's better to have a bit more buffer just in case there is a secondary dip, a secondary low before you start to see the next trend up. So there will be cases like this where the market will make a secondary low and then will go. But more often than not, the previous bar low will hold. But if you have a slight more buffer, it will just emotionally it will just be good because it will remove uh, the emotions going on at that level, or that are we in the right trade or are we in the wrong trade, those sort of things. Okay, let's look at some more examples. This is Bitcoin, and again, this was last year. All the charts that I've selected again are dated. They are none of these charts are recent. It's like like not happening like real time, like happening today or tomorrow, like yesterday or so. These are like a few months old, so no relevance as far as trading is concerned. Okay, Bitcoin. Likewise, nice uptrend took place. Notice the dip. So this is what I was saying earlier, is that notice over here you have a very strong bullish bar in this case, a very strong bullish bar. So in this case, it is better to wait because uh, uh, we don't know whether the price action will continue or whether there was subsequent bar. And quite rightly, it didn't make a new high. So only after once we got another sign indication over here that longs were again suggested. After that, again, there was a secondary dip, but notice this previous low was not broken, or even if we take this one, this was not broken. So depending on whether we got in over here, depending on we got in over here, both worked out because A, as I said, we saw earlier that the first dip after a bullish crossover in a in a trend which has reasonable momentum. Look, notice the momentum. Notice also a nice breakout taking place. Something like when this happens, the first dip is normally quite offers very good risk reward. Okay, what about STI? Very similar circumstance. First dip taking place. After that, first dip was over here, and then subsequently a secondary low. But even this offered a good chance for those. Supposing if you miss out an opportunity over here, this was a nice setup. Missed out over here, no problem. This was second chance. Again, after the crossover, this was the first dip. And as we saw earlier, that when the market has the first dip, especially notice the width. When the width is so wide, we saw in last week's presentation that the market invariably finds support more often than not at that 30 period moving average, provided the gap is reasonably wide. How do we identify whether the gap is wide or not? That it is good to see once the eye gets trained, we need to train the eyes. Once the eye gets trained, that is this a good way to is this a good reasonable width, is it not? You will also overlay momentum, etc., meaning look at the moment. If there is something like this momentum normally, and if you've seen a nice breakout, you will get those signs that sort of converge that yes, the probability is more often than not. Okay, let's look at a setup in a downtrend. These are some examples in an uptrend. Let's look at what happens in a downtrend. How do we do it in a downtrend? So firstly, how to identify a downtrend. So firstly, to downtrend, clearly it's the reverse. The shorter moving average must be below the longer moving average. And again, to recap, we have only been using two moving averages, 10 period, 30 period. So if it's a daily chart, this is the 30-day moving average and the 10-day moving average. We also saw last week we're using the exponential moving average. Both are exponential moving average as we saw last week. So again, I'm repeating just in case those who could not tune in last week, just so that they are at least able to capture the most important bits of today's presentation and also the important bits of last week's presentation. So please pardon me if this is like a broken record we're repeating again and again, but I've just found in my learning journey that repetition really helps a lot. Okay, so once we've identified the downtrend, we have to wait for a rebound. In the previous case of an uptrend, we have to wait for a dip. In the case of a downtrend, we need to wait for a rebound. Just like the previous setup, prices must be between the two moving averages. If it is under this, so something like this taking place, ignore. If it is above, ignore. Not meant for us, move on. There will be other opportunities coming. Okay, once that is done, then what's the next step? Wait for prices to show some sort of a reversal, meaning reversal of the minor rebound that we saw. We need to wait for prices to do that. So assume we are on this bar. What did we see earlier? That if it's a rebound, as long as prices are not making a new high, see in this bar, the price didn't make a new high. In that case, our setup becomes live. The trade is not on this bar. Why it's not on this bar? Because we don't know whether towards the close, will the market make a new high or the market will just stay flat. Only after confirmation that this bar's price action is over, if it's a daily chart, only on the close of that business day, close of the market, we will know whether the market closed, made a new high or made a new low. So in this case, the bar did not make a new high. Because it didn't make a new high, the setup was live over here. But as we saw earlier, the trade only becomes live in the next bar, in the subsequent bar, which is this bar. In this case, the market did not fall below the this bar's low. So consider selling once the previous bar low is surpassed. In this case, again over here, the the price was lower, but it didn't go below this bar. So we have to wait. In this bar, finally, prices went below the low of this bar. That was the entry point. Notice all along in this market didn't make a new high. It still made a new low. So higher highs, sorry, lower highs, lower lows, lower highs, lower low. Once the low of this bar was broken in this bar, the trade became live. On this bar, the trade became live. Once the trade becomes live, what is the stop? Exactly as we saw in the previous one, it's the low of this previous bar. So we can set the low over here, sorry, the high of this bar, or you can set the high of this bar. If you're conservative, set the high of this bar. If it's okay, then set the high of this bar. Normally, I don't use the stop loss of this bar. I would use the highest point. It's always good to have some additional buffer just in case there is some sort of a secondary high getting created. I normally take the highest point in this rebound, and then maybe add a few more pips just for additional buffer to set the stop loss. It just buys some more time. And then finally, in the to set the risk reward, it will be 1:1, the entry point minus the stop loss, and add that to the entry point. That will be the risk reward. But as we saw earlier, normally you will get at least a few 2-3 bars of continuation of price action once this setup is live. So notice, once this low was broken, subsequently there was a nice continuation of this downtrend. Let's see some examples. Again, deliberately I've taken this example because it's a rebound, it's a secondary high. So over in this case, where would the trade have been? We would have probably been live in this case because we saw the low of this bar getting broken. This was a minor marginal low over, one could have entered into this. Now, if that's the case, then the high of this bar, the high of this bar was the stop loss. So as we saw over here, adding a few more pips. That is why it's always good to have some more few more pips. If if you are not able to set a few more pips, then maybe just set this 30 period moving average if it is far enough. If it is very close, then there is no point. It's better to go slightly above that. But if there is sufficient gap between the 30 period and the high of the setup bar, it is better that we set the 30 period as the average. In this case, there was a rebound. There was a continuation. There was one more rebound. But in this case, had we kept a slightly, that is why keeping a slight more buffer or even the red line that was held. Subsequently, finally, the market fell. But again, it was stubborn. It just didn't go one line. Of course, the desired thing is something like this. The moment we enter, we want the trade to go in our favor. Sure, that's the most desired outcome. But sometimes the market may not do that way. And sometimes you will still have these 2 or 3 times secondary highs. But notice that particular highs were not broken. Notice it was not broken. So in this case, hence it is always better to set a bit more buffer, or if the gap is too wide between the setup bar and the red line, just keep the red line and maybe just 10 or few pips more from that line for additional buffer. Because in any case, the risk will not be too much because it's a pullback strategy. In this case, you will not be risking, like a few, like 1,000 pips or so. There will be a small risk. These are very small risk trades. Why? Because the bar's size is very small. So the risk will not be too much. Hence, you can afford to keep a bit more buffer, because in the end, the risk reward, adding that to the target for the trade will be, you will be capturing that in the target of the trade. So this is an example where sometimes you will have 2 or 3 times a secondary high getting created, and then subsequently the market goes in your favor. Likewise, similar examples. First time happened, second time, third time happened. After that, there was a trend change. First time happened, and then subsequently we saw. So um, whether it's a weekly chart, whether it's a daily chart, it's the same conditions, everything remains the same. So notice over here, a double top or a secondary high getting created over here. This was our entry point over here. Setup bar in between, and then subsequently 2 or 3 bars, but then it yet again made a secondary high before the downtrend continuing. So there will be cases like this, conditions like this. But as we saw in the first rebound after a crossover, the risk reward tends to be good. the market will more often than not show at least one more dip. Likewise, first rebound on a downtrend. First rebound on a downtrend. Of course, there may be other opportunities also that you will have. First rebound on a downtrend. This is dollar yen chart, daily chart. First rebound. And subsequently, there were other opportunities also very similar. Okay, the final part is let's see under what conditions this setup won't work because we need to be mindful of those conditions also. And choppy side. So first condition when it will not work, of course, is choppy. So chop is something that nobody can avoid, and nothing will work in a chop unless you're doing a mean reversion strategy, playing the range or a Bollinger Band kind of a strategy. Then yes, of course, that will. But any trend following strategy or dip buying, etc., will not work in a choppy sideways conditions. Or even if it, you will get setups. Those setups will probably won't give you a chance to exit at the right time. So, for example, let's say over here, a bullish crossover happened. Let me just get my laser. A bullish crossover happened over here, and let's say this was a setup. So in this bar we didn't get, maybe we got into this bar. So you still saw a few pips, but subsequently the market fell. Now you will, so even though the setup was there, the trade was there, but it just didn't give you enough to stay in the trade. It just subsequently reversed so fast. Over here also, okay, similar. Maybe we got a chance to get out. Maybe we got a 1:1 risk reward. But again, quite risky. It could have done something like this. Over here also, notice crossover taking place, very similar setup. We saw a high also, but then couldn't sustain. So when we have, how do we identify something like this is going to be chopped? When you have previous highs holding, previous lows holding, it is better to just wait. Let the market give a signal. Let the market give a close above a previous high. Over here, notice intraday basis we saw, but there was no close. Let the market give a close above the previous low. In this case, finally, we got a very strong bar, a close above. Let me get the pen. We saw so far in all this, we didn't get a close above. Sorry, pardon my drawing skills. In this case, there was no close above. Only a close above here, we saw a close above. Ah, okay, then that's when the market has started to trend. So the first condition is when the setup won't work when it is in a choppy sideways condition. There will be also cases where the market just does not give us a chance at all. Notice price just didn't go in this moving average. Only when it rebound after when this is when the damage is already done. After that, we got a chance to get it over here. So we don't know whether how much if it's a a larger correction, then one can say that okay, there will be another fall. But the most of the damage is already done over here. So what does one do in such a case where the market has broken a previous low and it's looking like it's going to trend? It's also something like a double top. One can say that okay, this was like a nice double top. It's showing us some sign, and maybe the trend has reversed from sideways to down. How do we capitalize something like this? Very similar. See, stock 600, fantastic downtrend, huge bars. But how does one capitalize? There was no rebound at all in this. In such a case, when you see in the previous side also we saw support getting broken, and notice the support, there was no support getting broken at all. This was all just previous lows holding. And for the first time, we saw support break. At such times, better to look at what's happening in VIX. And I'm saying VIX because this could be a very a benchmark sort of an indicator whether the markets are beginning to trend either ways on the upside or the downside. Notice over here, those two support breaks, whether it is this support break or in the case of Hang Seng, this support break, they were both associated with VIX breaking out of its previous highs. So whereas those markets broke below the previous low and VIX broke the previous high, that's a sign that okay, volatility could be beginning to shift after a long period of sideways. volatilities begin to shift. In such a case, one can go to a lower time frame. We saw stocks in that earlier chart was daily. One can move to a lower time frame. In lower time frame, one will be able to identify this market, this setup conditions. Likewise, so this was the first bar. So subsequently, we can go into a lower time frame to be able to identify market conditions where we can participate in that, because such fast-paced moves don't happen all the time. But in the event where we see something like this, where previous low still holding, and maybe we saw a nice rising market and then we saw a dip, but that dip was not able to take out the previous low, for example, and it was not able to take out the previous high, then perhaps maybe it's not worthwhile going into the shorter time frame. Only when you see a consistent signal both in the market that we are tracking and the gauge, the barometer, the risk gauge for that market, when both are showing similar signs, then we can go and see or identify conditions in a lower time frame. One lower time frame could be one way to look at it. Okay, the third condition when the setup won't work is when um, we are at the end of a trend. So, for example, over here we saw the market was say sideways. The market perhaps began to trade. We saw began to trend. Sorry, a nice downtrend. We also got the first dip, first rebound over here. A nice, and the trade was also live in this case. So the trade was live. We saw the break, the previous bar getting broken. This was the live bar, the trade bar. So we also got an opportunity. But subsequently notice that the moving average started to converge. The green line became flat, and the red line was still trending down, which was still fine. But as we saw earlier, that the low of the previous bar was not broken. At the same time, the high of the previous bar was not broken. That meant that this was a sign that perhaps the market is just going to remain in a range. It's not making new highs and not making new lows. So this could be an early sign, flattening of the both the lines. So here both started to flatten. Flattening of both the lines was a sign that the trend is beginning to change. And after that, we saw first crossover taking place. So now what the best way to do is, how do we keep out of this? The one way is that once prices don't make new highs, new lows. By definition, when prices don't make new highs and new lows, moving average width will narrow. The width between the two moving average will narrow. Why? Because prices are not making a new low. So hence you will start to see both moving averages converging. Once both moving average converge, that is a sign that to keep away. Why? Because for us, the wider the gap, the better the risk reward for us. So it is better to just keep aside. If you don't see new lows, don't see new highs, and both moving averages converging, gap between the two moving averages lessening, because that could be a sign that the trend is beginning to change. Likewise, over here, notice the market subsequently wait for the first dip. Good risk reward over here. The trade was live over here. Trade was also live over here. And then subsequently, what happened? Notice in all these cases, notice the slope of the red line is still rising, even though the slope of the green line may shorten. Why? Because it's sensitive. That's fine. The key is, sorry, the key is, the key is that the red line slope should be flat or rising. The red line slope should not be negative. Here, notice the red line slope turns negative. The green line is anyway negative. So in such a case, when you start to see that there is convergence of both moving averages, even though there was a trade setup over here, because these two were converging, notice the gap was just almost gone. See how wide the gap is across in the entire thing. But suddenly in this area, the gap was very narrow. And this was beginning to flatten. This was actually negative slope. Negative slope plus the gap between the two very narrow, and the market has already given us 2 3 chances. it is better to wait and watch, because this is the sign that the convergence of moving average could be a sign that a trend is beginning to change. It may not be necessarily changing from, say, an uptrend to downtrend. It could well be sideways also. That's fine. But the risk reward changes and the risk reward is no longer the same. So, hence, recapping that, the risk reward tends to be quite favorable, at least in the first dip. After that, notice finally at very important support and resistance points. So there was a nice opportunity here. Yes, we got a risk reward. We got the target also, because the bar was very small, so the risk was small. The target was already achieved in in the subsequent two bars. But normally, because the market is at a very important resistance, better to wait. We probably got lucky over here. That's fine, but better to wait. Better to let this previous high getting broken, and then on that first dip, look for an opportunity, because now the market is in uncharted territory, meaning the market is out of this sideway range that we saw. So the risk reward on the first dip will be more favorable than the risk reward on the first dip that occurs at a resistance. This is the first dip that occurs after a crossover at a market resistance. Stay away. It is better to wait and not chase everything. We don't need to pick up every dart that is coming to us. We only need to be the market. They will have several opportunities, such setups across time frames, across markets, and we will only be able to eat only as much as we can, the appetite, depending on our appetite. So, hence, it is better to be where we are slightly unsure. Better to stay away. But in conditions where the market will tell us it's a trending market, look at the momentum, look at the gap is increasing, that could be a good, better risk reward than something like this occurring at a time when the market is at previous resistance. And the lastly, better to wait. So when you have cases like this where it's just a one bar, notice this bar is just a one spike. There was no follow through price action after that. Now, in such a case, had we gone over here, the trade wouldn't have worked well. Why? Because this was a false price action. So when we see something like this, see what is the difference between this bar or this trend after a downtrend and something like this over here. There was continuation. There was continuation of price action. There was continuation of rise. But over here, there was no continuation. After this one, it was like a dead cat bounce. After one, subsequently, like a soda water, it just fizzled out. So one needs to see continuation of price action before we start to see the setup coming up, before a, a, a favorable setup coming up. This was a risky setup, and it went clearly, didn't last. It was just a very short one. So even though one would have entered, but you see, as I said earlier, you wouldn't have got a chance to exit. Even though you would have seen a few green pips in your favor, there was no chance to exit, and hence we cannot take this trade as a favorable trade. Even though, at least visually, it still looks that the market went in the money. The trade would have definitely gone in the money, but we cannot be sure whether we would have been able to get out in time. So hence, when there's just one bar, something like this, clearly nothing happened over here. Suddenly one bar, and after that no price action like that. Better to stay away. This was the final setup. Then, so just to recap very quickly, in conditions where we have to just be mindful of and just be reassess the risk reward a bit more carefully, is in one, sideway market conditions. Two, when we have cases where the price doesn't even hug the green line, forget coming in between the two moving average, the price is not even hugging the green line. In such a case, in such a case, look for the barometer. If it is equities, then look for a wix at least to show some sort of consistent signal, both the market showing support break and wix showing a resistance break. That could be a sign that maybe it's better to go in for a lower time frame than the usual time frame. So if this would have occurred in say 240, then go to one lower time frame to identify something like this. Then we saw that when the trend is coming to an end, there is prices don't make new lows, don't make new highs. They settle in a chop. Moving averages converge, and the risk reward doesn't look attractive at all. That's the time when the market conditions are changing. So stay away in those conditions. And we saw later on that trend changes as often happen when the gap between the two moving averages converges, when the red line slope of the red line either turns negative briefly or flattens, and the slope of the green line actually turns negative. And especially after 2 or 3 times when the market has already given you an opportunity. At such times, just wait and watch. Finally, at support important support resistance zones, if you have something like this, just wait, be mindful, wait for the market to either trend up or to trend down, and then take that action. And lastly, in cases where it's just a single spike, at such times, just wait for a follow through price action, and then look for a setup in a subsequent dip. Okay, just about in time. Let's open for Q&A. I'm sure you would have quite a few questions on this. Ethan, over to you.
Okay, just let me take a look at the questions. Okay, so we have the first question from Chu. Can this setup work on a lower time frame, such as the 1 minute, 5 minute, or 10 minutes chart?
By all means, it is good to explore that. Yes, but as we saw, the lowest in this presentation we've seen hourly, but and we saw in the previous presentation also we did everything from hourly, 4 hourly, daily, weekly, monthly, quarterly, across all time frames. We saw it's working. But by all means, yes, do explore 1 minute time frame. I'm not, I'm like I said, my trading horizon is not 1 minute, so I don't look at 1 minute charts for my trading journey. But perhaps that could be something that could be explored, and by all means, do explore that. But yes, as we saw, this is scalable across time frames. This is scalable um, across markets. So if it's working from hourly to quarterly, or even yearly also, there is no reason why it should not work on even smaller time frames.
Okay, thank you, Manish. So I think we have one question that is asking on your chart, right? You always label the moving average as PMA. What does the P stands for? Is it the period?
Correct. That is right. Period. Because very nice. On this screen, it shows Bitcoin 240 minutes. Now, if I were to label it 10 hourly is easy. 60 minutes HMA is hourly moving average, but then it'll be 4 HMA. So it's difficult to read. So the period is the period of the chart. So if it is 240-minute chart, then it is the 10 period moving average on the 240-minute chart. So it's like the 4 hourly moving average, but it becomes quite complex. 10 moving average of the 4 hourly, so it can be quite complex, quite mouthful also if I have to speak. So PMA becomes a bit easier to speak. So period, yeah, period of the chart that we are looking at. So if it's daily, if it's a daily chart, it's a daily moving average. It's a weekly chart, PMA stands for weekly moving average. So 10-week moving average, 30-week moving average, and so on.
Okay, so the next question we have is, in your experience, which indicators improve probability of trade setup in combination with moving average? Because this viewer would like to do back testing in combination with moving average. Is there any other indicators that could help improve the trading success on top of the moving averages?
Um, I'm, the literature has so many, and by all means, even I've explored quite a few. So, as I mentioned in the last presentation, that I've coded also. I've tried various strategies. I've tried even machine learning and using technicals, indicators for machine learning and seeing what comes out for predictive techniques also. Uh, and it would be wrong to say nothing works. They all work under certain conditions. The key is um, one is to understand what we're trying to achieve out of this. Second, we need to understand what our own mindset is, what our own horizon is. Am I a trend follower? Am I a top bottom picker? Am I more comfortable in mean reversion techniques? Depending on what my objective is, depending on what my mindset is, depending on what my comfort is with regards to a particular horizon and with regards to market conditions, depending on that, we can choose the average. But yes, There is literature, and all of these are so useful. All the indicators in technicals are very, very useful, but we must know how to use them. That's the only thing. Sometimes if an indicator doesn't work, and I'm talking about myself, I'm not talking about anybody else. If an indicator doesn't work, I feel it is, I have not explored it enough to be able to find as to why that indicator is not working. But there is research being done by the people who've developed it. So it definitely works, but perhaps it's my lack of research or my lack of study, or I've not been able to understand it in the way that it's meant to be applied. So all those things will come into play when I'm selecting the indicators. I hope it
Okay,
makes
thank you.
sense.
It does, it does. So I think we have one more question that's asking on the number of the moving average. So you were using 10 and 30, but in the case of a very bullish or very bearish condition, right? Is it possible to maybe use a 5 and 10 instead?
It's a very good point, because I think it's a very good point also as we end this presentation, also as well what we started from, that by all means do explore this. Try it with 510, try it with 520, like we saw in the last presentation, that maybe take one and then take a double of that, and maybe take a triple of that. I took a double and I explored with double 10 and 20, but I found that 1030 gave me the best risk reward. Why? Especially because where I found 30 was most useful, or the third three times the slower moving average, is when the market conditions are changing. You see, if it's very close, both are very close, then both slopes will change at the same time when the market condition not changing. So I found that if I take a triple of that, then the red slope doesn't change as often, and still allows me to get into participate in a trend when a dip takes place. But if both are very close, then both slopes may change. If slopes change, then as we saw, then that condition is not appropriate for getting into the trade. So that was another reason why I took one third, so 1 and 3, so one, and the second moving average was three times. But by all means, try 510, try 515, and see, maybe try 714, 721. 21 is also a Fibonacci number. Try that, try combinations of this, and then I'm sure that you'll perhaps even come across something which is works better even than a 1030 also. So that, I think, it sums up pretty much that use this is just one perspective. I'm just sharing one perspective. There are many perspectives out there. I'm sure that you already have so many perspectives also there. I'm sure that if you were to be presenting, I'm sure I'll also learn equally as much from whatever you studied. So this is just a sharing session. It's not so much. It's more of an education sharing session. It's not so much of a trading advice, or that this works all the time. No, it's just more of exploring session. And I hope you found this useful. And how would I know if it's useful? If it triggers some exploration for you, if it triggers an idea for you, like, okay, let me just try this out, let me try this out, I think it's worth it. Whether you use it or not, that's beside the point. But if it triggers an interest, triggers some curiosity for you, maybe let me try moving average this way, I think it's in the purpose would have achieved, for me at least. So with that, thank you very much really for joining. Pleasure to talk to you all in the last 2 weeks, and have a very good evening ahead. Thank you, Ethan, for having me for these presentations.
Great, thank you, Manish. So before we end off the session, I just wanted to highlight that we have this QR code over here at the screen. So if you can, I will just encourage you to scan this QR code. I promise it's a very, very short feedback form, lesser than 1 minute of your time. Let us know your honest feedback, your reviews of this session. And of course, more importantly, to highlight what are the future content that you would like to see. So it's easier for us to plan as well. Okay, so if not, then I want to thank everyone for joining us here today. And I think we still have some viewers that's asking for the recording. Some entered in late as well. So not to worry, I will be uploading this recording as soon as I can. So just keep a lookout in for both our YouTube channel and as well as our IG Academy as well. Okay, so with that, I want to thank everyone for joining us here today for this 1 hour webinar, and we'll see you in the next one. All right, and thanks again, Manish, for your time and for your wonderful sharing with us. All right, cheers.